Welcome to the daily update, where I'll go over the action in the market for Tuesday, April 8th, and we'll see how things look for Wednesday, April 9th. Really disappointing day. We had Japan up over 6%. We had Europe looking pretty strong. We had a gap higher open. Looked like, okay, we may not be turning positive, but at least we're going to get some kind of a bounce out of this. And we did for the first little bit. And then we hit resistance pretty much at Monday's high, which was also a pivot level for Tuesday. And we just saw a pretty orderly downward move after that. And so, yeah, we're pretty negative right now. We're extremely oversold. As I start to record this, it's about 8 hours before the market is set to open, and we're down over 2%. This is in reaction to the trade war between China and the U.S., and things are just looking pretty negative right now. And any attempt to bounce or try to relieve some of these oversold conditions doesn't really seem to matter. We're seeing a lot of selling into any strength that may come into the market. Buy the dip is definitely not working. And as I said in yesterday's video, it's a professionals market right now. And if you just try to think, okay, well, we're going to go up from here, I think we've gone far enough, I'm going to buy the dip, you're getting decimated by doing that because we were hoping, at least based on the open on Tuesday, that, okay, let's get some kind of a bounce and then reevaluate things. Well, we didn't even get a chance to do that. We started going down and ended up closing lower on the day. All right, so right at the open, we did have a gap higher open, but we hit resistance at R1 at 52.61, which was Monday's high. And then we just spent the rest of the day going down. We declined below the unchanged level to go negative, and we were up pretty strong there. We went below the daily pivot at 5,048. We dropped below 5,000 and we found some support at 49.10. And we closed a little bit off of that, but still below the 5,000 level. We were down 1.57% on above average volume. The volume was still up and above average, but it dropped off from Monday's session. And we are negative in the short, intermediate term. We're mixed in the long term. And as I keep saying, the longer we stay below the 200-day moving average and even the 50-period moving average, the more we could see a death cross for the longer term trend. And we're starting to see that. We've already seen that with the small caps and the mid caps. Now we're seeing some weakness drifting into other indexes that I'll go through here in just a moment. And we're seeing this flight back to safety again. We're going back into bonds. So it's just kind of a reverse of what we saw in Monday's session. And it's all about the fears over what's going to happen with these trade wars and the tariffs and things that are unfolding now. So we were up over 4% at the open, but then we ended up closing down 1.57%. So 5.5% move within one day. That's a big move. Doesn't look all that drastic on the chart when I show you that, but it's just because in context, the last number of trading sessions, we've gone down so much. It makes this move look smaller, at least visually. And then the White House did confirm that a 104% tariffs are going to be placed on imports from China, and it went into effect April 9th. And that's when the futures were negative. They really went negative right as we clicked over into April 9th. Mega caps and semis, they had a pretty good day on Monday, but not such a good day on Tuesday. The VIX is now above 50. And as I've been saying, we get concerned when the VIX is above 20. We get really concerned when it's above 30. We get downright really nervous if it gets above 40. Now we're above 50 at 52.33. And we have a very long list in the short term of oversold indicators here. The ADX, that's the short term trend. We're still getting an extreme reading with the 20-period moving average of the S&P. The VIX, it just keeps going up, and so we're getting an extreme reading there. The slope oscillator now, that has been extreme negative. And the MACD, these are a lot of our momentum oscillators here. And then the rate of change going back 5, 10, and 20 periods. the Stochastic RSI, Williams percent R, CCI 14 and 20. These four indicators here are usually, if we're going up, they're extreme positive. If we're going down, they're extreme negative. These other ones just kind of come and go and give us a little bit more insight of how oversold the market is right now. The stochastics, the force index, we're far away from the 20 period moving average with the boom indicator, and then the shorter term RSI. Long list. And we also have a long list in the intermediate term. The Chaikin oscillator, the CMB composite, the Connors RSI, which is not on this list very often. Now we're seeing the TTM squeeze getting extreme negative. And then the intermediate term trend measured by the ADX, the 50 period moving average on the S&P, we're still well into that lower end of the -3 channel on the standard deviations chart. And then the more intermediate term rate of change going back 50 periods, the Arun, the PMO, and then just looking at the PMO itself, and then some studies that go along with that, the additional chart that I show, the Sean trend meter, the bullish percent index for the S&P, NYSE, and NASDAQ 100. And we're getting really extreme with the NASDAQ 100 reading. And let's see, the boom, we're getting far away from the 50 period moving average and the RSI intermediate term, as well as the McClellan oscillator for the S&P and NYSE. Big long list here, but it doesn't seem to matter at this point. Long term, we have the 200 periods exponential moving average and then our 150 and 200 period moving average studies. Very long list here. There's nothing to say that we have to stop going down, but at some point, we should at least slow down and maybe chop sideways, maybe see a little bit of a bounce to work off some of these extreme readings. No real change with the Fed here. We will get the meeting minutes in Wednesday's session. That'll come out at 2 p.m. Eastern time. The dollar was down, interest rates were up here. Actually, I was incorrect. It's not back to the flight to safety. We're at 4.26%, where we had been at 4.17%. Now, just last Friday, we closed under 4% at 3.99, and we've already climbed over 1/4% just in Monday and Tuesday session. So I misspoke about the flight to safety. And we're not changing. We're getting about as low as we can get here with our sentiment readings. We were at 4 after Monday. We're at 4 still after Tuesday. We get nervous when we drop below 25. And the 10 to the 3-month yield curve, it's even now. So the yield for the 10-year, the yield for the 3-month, they are the same. And then we're quite negative here with our trend. The ADX is still going up. We're starting to look extreme, both in the short and intermediate term there. And of course, with the down day, the bias is negative and the momentum is negative. So you have a really negative looking market right now. But at some point, we're going to need some buyers to come back in to say, okay, we think prices have fallen enough. Now's a good time to step in. We're just not quite sure when that will be. All right, we just had the NFIB Small Business Optimism Survey, which did drop. Last time it came in at 100.7, this time at 97.4. And here's a chart of that where since December, it's been declining here. And some of this has to do with uncertainty about the economy. Are we going to go into a recession? And since most folks work for small businesses, this has most of the impact on folks. And so if they're seeing confidence going down or feeling less optimistic about things, that is more negative. Then once a week, we get the overbought, oversold composite. Now, this was after Monday, and we're coming in at 7. All right. That's a very low reading, which is usually where we would see a bounce. Now, things are quite negative. It's still 8 hours before the market opens. Even if we have a lower open, possibly at some point during the day, we could see some buying coming in. But this could also drop further from where it's at right now. And it says a weak first quarter could be a warning sign for the rest of the year. Not all that big of a deal here. It just looks over the last number of years where we had a down quarter and then what the average is going back to that time. But they're looking at for the rest of the year a little more positive than negative going forward, where quite often we will see some positive action more in the short term. And then there have been 3 times that we have here on the chart where we did go into a bear market without going into a recession. Now, we're going to be watching all the recession charts, and that data will be released. People are predicting that we will, some are predicting that we won't. We just have to watch the data as it becomes available to us. And then over here in the 2025 area, even though the Magnificent Seven earnings are outpacing the rest of the S&P 500, they're coming down quite a bit. And this is something we started to see back in late 2024, where the earnings are still positive, but not as optimistic as they were before. And so we're seeing more of a tightening between the Magnificent Seven and the rest of the S&P 500. Then financial conditions tightened last week, and has to do with the reciprocal tariffs, and then China and the U.S. going back and forth. And so this line is going up, and that puts pressure on the market as well. And then looking at real GDP growth here, and the red box that you see here, this was what it was looking like as of January 17th. This is what it's looking like now. So they're revising down the GDP. And the takeaway also from this is that we're below zero. That means negative GDP. And if we see negative GDP here, they're still predicting it'll be okay for the first quarter. But going out into the second, third, and fourth quarter, that's negative 2 quarters in a row would be a recession when it's combined with other charts. That's why we're really paying attention to the employment situation. With some of the Doge cuts and different jockeying that's going on, maybe that's going to start coming through at some point in the employment data. So we'll really be watching that. We won't get in the jobless claims until Thursday. And then forward 2 week returns based on the level of the sentiment indicator being quite negative here. Okay, it's just kind of take your pick as far as this one. And we're starting to get extreme negative as far as the risk appetite. Now, this could still go lower than where it's at, but people are pretty freaked out right now. But we're getting a very low reading here, which is also lining up with a lot of the oversold conditions that we're seeing with our charts. We're starting to revise up the probability of a recession. Goldman Sachs is coming in at about 45% chance. Bloomberg, that's moving up to a 30% chance. So this keeps increasing here. And this is just for informational purposes. 2 day performance. This goes back to last Thursday and Friday. When did we see really bad back-to-back days? Well, this was Black Monday. That was a pretty bad day in 1987, if you remember that. The great financial crisis. And then, of course, we had the COVID crash. And coming in here as well is the reciprocal tariffs. All right, so here is the chart, and it really was looking like, okay, Monday seemed like a fairly good setup here. We this was the false news that came out that maybe there was going to be a 90-day delay in the tariffs. Well, that was shown as being false, so then we quickly came back down. We chopped, but we didn't really head lower. We just kind of held on to things right around the 5,000 level and closed a little bit above 5,000, but we were still down on the day. And then it looked like, okay, Japan is looking strong, Europe is looking strong, so we gapped higher, but then we hit this resistance right at R1, which was the high for the previous day on Monday, and that was it. We just couldn't break through that. And then we spent this time just coming down. We battled around the unchanged level in the daily pivot for a while, but then we ended up breaking down and closing a little bit off of the low. But this is showing more conviction to the downside. This is more orderly selling of what we saw. And we're also negative here going into the initial overnight session. We were looking quite positive with the initial overnight session. And then before the market opened, the pre-market, and things were looking good right off the bat. And then everything turned and started to go back down. And we're still seeing where both value and growth are getting hit right now. We're trying to see as this works its way out, is the red line or the blue line going to be on top and actually be outperforming the other one? Not much of an improvement, at least going into the close, but we were looking better. Growth was doing good. It started off really well. A lot of the Magnificent Seven stocks, a lot of the stocks that really helped the market to go up, they started off positive, but then gave those gains back as folks who tried to buy the dip were suddenly seeing pretty significant losses. Okay, here's our end of day chart where we were pretty even. Growth was down a little bit less, but both value and growth got hit. We were down a little bit less, but still really strong with the mid caps, and less, but still a significant loss with the small caps. So our growth to value ratios for the small caps still battling under the 200-day moving average. The longer we stay down here, the more this blue line is going to come down, and we could see a death cross with this ratio. Same thing here, a little bit of a tick up, but below the 200-day moving average with mid cap growth to value. No real improvement here and getting close to a death cross with the S&P growth to value ratio. And just kind of not really changing all that much, but still looking all that weak when we compare the growth versus value ETFs. And discretionary to staples still really coming down. And here's the the intermediate term trend where we came down with the red line. It picked up the more positive open, but it's still above 40. And that's why we're saying that this is extreme. We're at 38 right now with the ADX. If we get above 40, that would be an extreme reading for the indicator itself. But this is clearly negative with the red line, even though it's coming down, is way above the green line, which is also still declining. Here's the short term, also rolling over with the selling, but we're well above 40 in the short term with the ADX itself, quite negative there. We were above average with volume, but it did drop off from Monday's session. And we're still not, at least officially, in bear market territory yet. This gets calculated around the close price, where I also look at the intraday prices, but we're down 18.9% from the all-time high that was set back in February. If we go over that 20% level, that's when we're in a bear market, and that'll change a lot of perspectives for a lot of money managers and investors and traders, and it'll just kind of go into a new realm there. So we've been able to hang off doing that at least up to this point. We're really going up at the fear gauge here with the Ulcer Index. This is designed more with mutual funds, and it was one of the first indicators that you could use because it's based on end of day data, which that's what mutual funds are based on. Just skyrocketing to the moon here with the VIX, coming in at 52.33, going up with the VIX of the VIX, just skyrocketing up here. But we've been going pretty fast, but we've seen this now for a number of days with the VIX moving pretty quickly here with the RSI based on 9 periods. The momentum clearly for the VIX is up. That's negative. And when we're above 20 with the VIX, this is Tom Bowley's research here from stockcharts.com and earningsbeats.com. This is when we see the negative annualized returns. And that's pretty much what we're seeing right now if you were to annualize things out. The fear gauge that we follow here really going up strongly. The other fear gauge also going back up. We're not seeing much of a change here with the risk on to risk off ratio. We were looking better, but then we ended up closing lower with this particular ratio, but it was trying to improve earlier in the day. And this is another concern. We're really dropping here when we look at the spread between risky and not as risky bonds. The high grade bonds, those are the non-risky bonds versus junk bonds. And this is really coming down. Now, we could still go get a lot more fear than what we have right now, but this really falling is causing some concerns. This matches up the spread that we just saw when it's charted normally here. And this is the black line, which it's going up, and you can see how the VIX is going up too. This is just to get an idea of how are the VIX and this spread study that we look at, and how do they compare with each other. And I use the spread, the credit spreads they call them here. I use that more as a sentiment gauge. That's why it lines up well with the VIX. And trying to improve earlier in the day with the high beta versus the low beta ratio, but this ended up declining again. We're going up with the equity put call ratio on the daily chart. We're moving up here on the 5-day chart, and we're going up on the 10-day chart. And we're starting to go up, but we're still just at the upper end of the band with volatility risk premium, but fear is starting to increase. So all of our fear gauges are confirming what most market participants are feeling. They're fearful right now. And we are seeing further deterioration here. We're still above the moving average with the advanced decline line based on price, but we're falling further below the moving average based on volume. And for quite a while, this had been holding up as we were seeing more rotation into value from growth. Now we're just seeing money starting to come out of the market. And that's showing up more in our internal measures here. Getting down here, but not quite extreme negative, or at least right on the border. When we look at the advancers decliners over the last 10 day, we use this like an oscillator. Once it drops down below this green line, then that means that things are getting quite negative. Internally, too, we did see an expansion of the new lows, but not quite as much as what we saw after the gap lower open on Monday and everything going all crazy there. But we're clearly going down with the 5 day and the 10-day chart. So this is showing internal weakness. We're below the red line and going down with accumulation distribution. That's negative. We're really moving down here with our advanced decline ratios, both short and intermediate term. We're well below zero and declining based on price and volume with the 19-day advanced decline ratio. The number two smart money indicator still going down with the red line, dropping back to negative with the histogram. So two out of the three of our indicators are negative, and here we have 3 out of 3, but we're starting to get extreme negative with this pink line here. Now, sometimes this can produce some kind of a tradable bounce. We'll have to see if this continues to go down. Are we going to see some kind of reprieve in declining prices? And we're negative with the vortex with the red line above the green line. And we're starting to see more weakness now with the advanced decline line studies that we look at. Coming down, but still holding up fairly well with the cumulative advanced decline line for the S&P based on price. Seeing more of a deterioration here based on volume. We're below 50 and declining with the 10-day average of the highs and lows for the S&P. That's negative, more longer term. And even a little bit more longer term is the 50 period new highs, new lows average for the S&P. That's below zero and now declining. And then we look at the broader market, the cumulative advanced decline line for the NYSE really showing some weakness, also breaking down with the regular NYSE advanced decline line and dropping further below the 200-day moving average with this other NYSE advanced decline line. And I show two of these because they're calculated in a slightly different way. So that's why I have two NYSE advanced decline lines. Then we break it out based on common stock, where we're starting to see more weakness coming in, both based on price and volume. We're below the moving averages and declining here. This moving average is calculated a little bit different here, but we've already been negative and declining now with the NYSE common stock, seeing more weakness now with the S&P and continued weakness with the mid caps and the small caps, and really getting an extreme negative reading here. We look at a broad market measure by taking the Amex, NASDAQ, and NYSE, putting them together, and then looking at a 5 day moving average of the highs minus the lows. This is below the red line, and this is also an oversold indication right now, but it could still fall further from where it's at right now. But it's just lining up with our other extreme negative indicators that we're seeing. Still, again, the stocks in the S&P above their 20 period moving average, it's 2%. Okay, just it's very, very low reading, but we're also getting a low reading with those stocks above their 50-day moving average, extreme negative with those above their 100 period moving average, and only 18.6% are above their 200-day moving average. So here we go, just not looking really good right now. It was kind of an inside day, but we've been seeing an awful lot of volatility right now, but just breaking through this previous support of these pivot lines. And we were above average with volume, but it did taper off from what we saw on Monday. We're extreme negative with the 20, 50, and 200 period exponential moving average on the S&P itself. And then our usual charts that are showing that there's some conviction here in the short term. We're extreme negative with the Stochastic RSI. The Williams percent are ticked back down. The CCI 14 and the CCI 20. And then the short-term stochastics, and this is short-term because this is a further subdivision, excuse me, of the short-term time frame. Gotta love these take one videos. I just hit the button and record, so I can pound out these videos a lot quicker this way. But we are getting extreme negative in the short term. We tried to tick up, but we're still extreme negative in the intermediate short term, going sideways to slightly down again with the long short term. So all of three of these charts are extreme negative. And we're really extreme negative here with the force index. We're just going down the tubes there. The condition of the short-term trend continues to be weak. We're below both the green line and the blue line, and we're just falling here. And this is the intraday measure. Now, we didn't exceed that in Tuesday's session, but this goes back to the intraday high on February 19th, the intraday low that was set on Friday. I guess that would be Monday here. And on an intraday basis, we're already in bear market territory, down 21.4%. But the official definition is on a closing basis. And here's the rate of change charts. They were already extreme negative. Now they're even more so, with the rate of change going back 5 periods, 10 periods, 20 periods. These are all short term. And we're way down here with the -3 reading in the standard deviations chart. And then this is a newer chart that I started showing. This is called Trueflation. And feel free to check that out if you want to see what's happening. But we're down at 1.4% right here. This is giving us a little bit different insight as to what inflation's actually doing, because we're going to be getting CPI and PPI this week. We'll see how they match up with this. Intermediate term, just we've been chopping around the midpoint here with the balance of power, but it's now chopping back over negative. A little more neutral with this reading here, but we're extreme negative with the CMB composite. We're below the black line. We're extreme negative again with the Coroner's RSI, looking really negative with the deep purple bars here with the go no go system. The lowest low value just keeps going down here. And here's the TTM squeeze. We're dropping below this black line. And to give it a longer term perspective, just you can see where this lines up with other extreme readings that we've been seeing. And the condition of the intermediate term trend negative. The blue line and the red line continue to decline. And we're just not really using anything as support right now. Not much is really acting as resistance either with our anchored moving averages here. Below all the simple and exponential moving averages that we plot here, and we're just watching these shorter term moving averages continue to fall. And if we start falling below the green one, if it falls below the gold one here, that's when we're going to have a death cross with the 50 period crossing below the 200 period. Really extreme when we look at how far away we are below the 20, 50 moving averages, and we're not extreme yet, but we're clearly negative. If we get down to this 15 level, then we'll get far away from the 200 period moving average. And then more intermediate term, the 50 period rate of change, also extreme negative. Standard deviation is very high, as we've been just screaming over the last 10 periods to the downside. Negative, but tried to bounce up here with the ease of movement, but it's quite negative and possibly extreme negative there. Extreme negative with the Arun indicator. That means that sellers are in control right now. And starting to get extreme negative with the S&P McClellan oscillator. We're going down with the summation index based on price and volume. Getting extreme with the NYSE, another broad market measure here with the NYSE McClellan oscillator. So we're continuing to decline with the summation index based on price and volume for the NYSE. Swell trading oscillator, declining below the midpoint based on price and volume, negative there. Really getting negative with the PMO, the price momentum oscillator, and we're declining based on price and volume when you break the two out of each other. Extreme with our PMOs that are rising, that's extreme negative. The buy signals are extreme negative, and we're declining and not quite extreme with the PMOs that are above zero, that are inside the S&P. We're negative with the Elder's Impulse system with the red bars with the S&P. We're negative with the parabolic SAR since the dots are on top. We're extreme negative here with a short-term slope oscillator, but it's still negative. The MACD is starting to become extreme negative as well. All of our oscillators are now negative with the shorter term here. This is actually, it could go lower than where we're at right now. We're starting to get to a new low with the TSI, the other short-term oscillator. The MACD, extreme negative, as is the PMO, the PPO, and we're starting to get extreme with the TRIX. And the KST is just about matching the previous low. Copic curve, negative as well. Extreme negative with the Sean trend meter. Actually ticked up a little bit, but we're still below 50 with the money flow, and we ticked down and below 50 with the ultimate oscillator. The money flow and the ultimate oscillator I consider to be secondary indicators, and they're confirming what we're seeing with our primary indicators, and that's negative. We're falling further below the moving average with unbalanced volume. We're ticking back up here a little bit with the percent B indicator, but we're still extreme negative. And we're extreme negative in the intermediate term RSI. That's based on 14 periods, and the short term RSI, which is based on 9 periods. Getting really extreme here with the bullish percent index for the S&P, extreme negative with the NYSE bullish percent index, and really, really extreme with the NASDAQ 100 bullish percent index. In fact, over the last 20 years, you can see where the low reading is compared to other times. This was during the COVID crash. And then we had some difficult times back in 2022. This is a great financial crisis over here. So yeah, this is extreme negative, but believe it or not, it could still go lower than where it's at right now. And then we're looking at the condition of the SPY, which is the ETF for the S&P 500, to staples ratio. Staples are more defensive. This is what we saw at the end of 2021, and it started to roll over. Price didn't hit an all-time high until early 2022. Now, we're not really seeing that because everything's been falling apart now. We're not seeing anything really leading other than the fact that this is showing a lot of weakness right now to suggest that there still could be lower lows with the SPY here because this tends to break down before we see a breakdown with the index itself. So I would take this as more negative currently. And we're still working off of a buy signal with the mass index, but these are the only, this chart and this chart are the only two that are saying buy. Everything else is saying sell, which usually is kind of a extreme reading in and of itself when everything is pointing in one direction. But we've been seeing that for a while now. And we're still holding out above this 50% retracement level. If we really start to fall and we break this level, especially on a closing basis, that's going to turn things quite negative. And this measures from the October 2022 low to the February 2025 high. We came down and tested this, and so far we're holding above that. But if we fall under this 58.29 level, 48.29 level and close below that, that's going to mean that we've given up over half of the gains from that October 2022 low to the February 2025 high. And we did close down below this support. We were hanging on to some hope here. In Friday's session, we closed right down here at the S1. We were able to hold it after Monday. We lost it now after Tuesday. But this is a weekly chart, so it won't be official until Friday's close. And then we're falling down below the midpoint here with the trend channel. We've been holding on to the middle. Now we're starting to break below it. So we're seeing a further breakdown of some long-term support levels. This is a newer chart here. And I draw this on here, so it may not be exact. I'm a little off here with the low. You try to connect these two lows and then extend it forward. We're starting to break down below this long-term trend line, which had been holding so far. If we close and break down below that, that's going to turn more, it's going to look more negative longer term. Then we are negative with the Heiken Ashi chart with the black candles. We're actually negative but pointing up with the Kegi chart. That's showing a little improvement. It like that higher open that we had. We are negative with the Renko chart with the red blocks, and we're negative with the 3-line break there. And we saw enough of an upward move to draw in some green X's, and then we declined after that, but it wasn't enough to draw in any more O's here. So this is actually showing some improvement, but we're still below this blue upward sloping trend line here, which is kind of matching it right now. And now what we're seeing is a red line coming down here as things are turning more negative. The blue lines are positive, showing uptrends. When we start to see the red lines, that's starting to signal downtrends. And this is a low pole reversal that was generated in Tuesday's session. But again, it's not really picking up any more of the weakness that we saw later on in the day. All right, and we're getting extreme negative with our 150 and 200 period moving average studies. We're negative across the board with the mid caps and small caps. Still negative in the short and intermediate term with the S&P and the NASDAQ 100. And we're negative again here in the short and long term with bonds based on price. Commodities are under pressure in the short and intermediate term, as is the U.S. dollar. All the sectors ended up being down, with financials being down the least, which that's kind of positive if the financials are holding up a little bit better. Utilities were down. That's more of a defensive play. Healthcare, that's a defensive play. But then we see communication, tech, and discretionary. Those are the three big growth areas. They started off pretty good, and growth was doing quite well, but then it got hit later on in the day. And so we saw a lot of positive things at the open, and then it all turned to negative things later on. So you can see there's a clear line in the sand here between positive and negative. And the Dow still well below its 200-day moving average, below this S2 level. We're also watching this 50-period moving average continue to fall. We're negative with the diamonds with the Elder's Impulse system. We're getting close to a death cross here with the NASDAQ. That could be pretty significant, and we're dropping further below this S2 support level. And we're negative with the NASDAQ with the Elder's Impulse system, getting close, not quite as close, but still close with a death cross for the NASDAQ 100, and also below this S2 support level. Negative with the Qs when looking at the Elder's Impulse system. The momentum could be getting extreme negative here, measured by the PPO for the NASDAQ 100. And we're already in a downtrend with the small caps and just dropping below support. Then the other small cap index, the Russell 2000, we've been extreme negative with the RSI. We're in a downtrend. Momentum is negative, possibly getting extreme negative, but it doesn't seem to matter at this point. And then small caps with the Elder's Impulse system are negative. Mid caps also in a downtrend now, breaking below this S1 support level. Negative with the Elder's Impulse system for the mid caps, falling further below the 200-day moving average and getting close to a death cross here with the Wilshire 5000, which is a broad market measure, as is the total U.S. stock ETF, getting close to a death cross here if things don't improve fairly soon. We're falling further below the 200-day moving average with the financial sector, even though it's still in a longer-term uptrend. This is holding up a little bit better. That's more encouraging, even though it's getting hit with everything else. The FANG index falling further below its 200-day moving average. Then we look at some of the Magnificent 7 or Grade 8 or whatever, Illustrious 11. We're seeing a death cross here with Apple, and it was down almost 5%. That's not a good sign there. Amazon down 2.62%. We're seeing the 50-period moving average really coming down further below its 200-day moving average. In a downtrend is Microsoft, but it's been that way for a while. It started in this downtrend going into the end of February, but it was down 0.92%. Google could be getting close to a death cross here. It was down 1.4%. Nvidia is in a downtrend, down 1.37%. Tesla, which is having a hard time these days, down 4.9%, getting close to a death cross. Meta, which is looking better on a trending basis, the blue line and the red line are further apart, but it got hit for over 1%. And Netflix also still above its 200-day moving average. It was actually up 0.3%. And we're not seeing much of a change, but overall, the staples to tech ratio is going up, and that's negative. That means staples are outperforming the tech sector. And we're seeing a pretty strong correlation as we're seeing things really deteriorate on a global basis, not only just in the US. So the short-term correlation is pretty strong, and we're seeing a strong, or it's getting stronger with the longer-term correlation. Oil continues to drop though. So this is not inflationary. It's actually coming down and we're dropping below 60. We're at 59.58. The dollar is still seeing some weakness below its 200-day moving average. And then we look at bond prices going, or bond yields going up. We're back above the 200-day moving average here. And bond prices with the 7 to 10-year bond are going down. We're back to even with the 10 to the 3-month yield curve. So if we go back up and no longer are inverted, that's when we start the countdown to see, okay, are we going to go into a recession? And we're looking more like this hard landing scenario is what the market is starting to anticipate here. When we're above this rainbow, that means they're anticipating a soft landing, which means no recession. A hard landing means, yes, we could go into a recession. And then these are charts, they're just looking a little bit weaker than what we saw after Monday. A broad market measure to short-term bonds continues to fall. A broad market measure to 3 to 7-year bonds falling. The tech sector to 3 to 7-year bonds falling. The Qs to 3 to 7-year bonds falling. Home construction, which was one of the first areas to become weak. It was actually starting to get weak back in 2024. This is still continuing to fall. This ratio was down over 3.5%. And then riskier bonds, that's junk bonds, to more conservative bonds like high grade bonds, government bonds, corporate bonds. This is continuing to fall, which is kind of lining up with that chart that I showed at the beginning of the spread between risky and not as risky bonds. And we're still looking more negative here with our growth to value ratios, the Qs to S&P coming back down. This is actually holding up a little bit better, discretionary to S&P, but it's not showing any strength. We're still below a declining moving average when we look at large cap growth versus large cap value. And so the large caps, mid caps, and small caps are holding up a little bit better, but both the large caps and mid caps are under a declining moving average. And this is also an extreme negative reading with those stocks in the S&P above their 50-period moving average. We're getting a reading of 5.2. That's when we use this like an oscillator, which again, it could still go lower than where we're at right now, but it's already extreme negative. And we're seeing a very low reading at 2.5 with the mid caps and a reading of 2.83 here with the small caps. So we're seeing all these indexes are extreme negative based on this chart at the same time. We're still going down here. That's negative. When this ratio goes down, that means the S&P is underperforming utilities. And we're still going up for the most part here with staples to S&P. That means the market's becoming more defensive. We're off of this high reading here, but overall, this real spike up is causing us some concern. So what's the outlook for Wednesday? No real changes here other than we just continue to go down. We're negative in the short and intermediate term. For the time being, we're still mixed with the long term. We're going to get the MBA mortgage applications index, which we get every week, wholesale inventories, and then kind of the big one, if it's even going to be all that relevant in and of itself, will be the meeting minutes from that last FOMC meeting. And then it's all about tariffs and Doge and cuts and trade wars and everything right now. And then we're going to get CPI on Thursday and then PPI on Friday, as well as consumer sentiment. Here's a look again at what the previous readings were and what the forecast is for the economic reports. Seasonality neutral to negative, no real slight, it's actually a little more negative here for April 9th. And we look here, it looks a little more positive, but it's pretty much flat when we look at the solid line. We do see some positive seasonality with the green dash line, but it's like seasonality is just flying out the window right now. The market's so focused on what's going on rather than looking at what historically has happened before. And April is supposed to be positive, whether you go back to 1950, the last 20 years, the last 10 years, or a post-election year. Not so far. All right, so we are negative with our three smart money indicators. We're also negative with the S&P and NYSE McClellan oscillators. Those are getting extreme negative, where the summation indexes are just negative. Parabolic SCR is negative. The momentum is negative for the S&P. The bullish percent indexes, we're starting to get extreme negative here, especially with the NASDAQ 100. The swell trading oscillator, the moving average studies, all those are getting, well, the moving average studies are getting extreme. The swell trading oscillator is just declining. Ease of movement, money flow, and ultimate oscillator. Those are all negative. The vortex is negative, and the special K chart, which I don't show here because we only get one or two signals a year or more, that is still negative, and the momentum for the NASDAQ 100 is negative and possibly extreme negative. Positive signs are we're still hanging on to longer term uptrends when we look at growth to value and discretionary to staples, but this could be changing pretty soon because we are quite negative in the short term. Financial sector is still holding up, but we still have the bank ETF well below its 200-day simple moving average, and we're getting buy signals from both the mass index and the Pring bottom fisher, but it's like they're the only ones flashing anything that looks positive right now. The conclusion, we are still negative in the short and intermediate term, mixed in the long term, but we're oversold. And that's what we're seeing here in the short and intermediate term. And we're just going to see if we can't get above that 200-day simple moving average, we are probably going to see a death cross here pretty soon with the long-term trend. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.